Wall Street always seems to have something up its sleeve. There's always a new way to make profit out of nothing or avoid paying taxes where we as individuals would normally have to, but they can easily dodge it because of their political influence. We have seen every trick in the book, whether it's the ninja loans, collateralized debt obligations, the LIBOR scandal, they all seem to constantly be up to something. Let's see what they're up to now. You came here for the truth, so let me unveil that for you. Today we're going to talk about Wall Street's dirty little ETF secret. Bloomberg had this fantastic expose on the ETFs, what they're up to today, and I think it's important to cover this information, as I always do, to let you know what's happening behind the scenes. People invest in stocks, they invest in ETFs, they put their money in bonds, they have no idea what's going on. As long as they see the money in that account, hopefully it's higher than where they bought it, they'll shut their mouth, and that is such a dangerous thing. They didn't learn with the Enron scandal. They didn't learn with Bre-X. They didn't learn with the CDOs and the derivatives from 2008. But there still has to be somebody out there speaking up. So that's what we'll do today. Out of Bloomberg, the ETF tax dodge is Wall Street's dirty little secret. Banks are pumping billions of dollars into and out of funds with heartbeat trades. There's a lot in this specific article right here, and I want to get to all of it. So I'm going to read through. I'm going to try not to go off on a tangent. So stay with me as we look into this here. It's a lot of information, but I'll cover it as quick as I possibly can. So sit back, relax, grab a coffee. I'm going to read this all to you. I'm going to try to describe all of the diagrams, the charts that are in this article as well. Let's begin. One day last September, an unidentified trader pumped more than $3 billion into a tech fund run by State Street Corp. 2 days later, that trader pulled out a similar amount. Why would somebody make such a large bet 5 times bigger than any previous transaction in the fund and then reverse it so quickly? It turns out that transfusions like these are tax dodges carried out by the world's largest asset managers with help from investment banks. The beneficiaries are the long-term investors in ETFs. Such trades, nicknamed, quote, heartbeats, are rampant across the $4 trillion US ETF market, with more than 500 made in the past year. One ETF manager calls the industry's dirty little secret. You have to know what's happening today within ETFs. If they make a change, and I'll talk about this more in a moment, if they make that change, we are in for a world of hurt for those who are invested in ETFs. So we're going to scroll down, cover a bit more information. Typically, when you sell a stock for more than you paid, you owe a tax on the gain. But thanks to a quirk in a Nixon-era tax law, funds can avoid that tax if they use the stock to pay off a withdrawing fund investor. Heartbeats come into play when there isn't an existing investor handy. A fund manager asks a friendly bank to create extra withdrawals by rapidly pumping assets in and out. Can you believe this? Can you believe the scams that they're up to today? We always knew that they were up to no good, but breaking it down like this is so fantastic. That's why I just really want to cover all the information in here. That's quite a pulse. Banks help ETFs avoid billions of dollars in taxable gains by quickly pumping money in and out. This happens to be State Street's technology select sector. You're seeing billions of dollars. It looks like maybe $3.5 billion that goes in and out in a matter of a day. Okay, this is a huge change. This happens to be, in this case, with Facebook and other stocks leaving the ETF, a heartbeat helped avoid a tax bill. So when they changed that over, they were able to skirt around any tax issues. And this is with others as well. BlackRock's iShares Select Dividend ETF happened multiple times, billions and billions of dollars worth. Vanguard's small cap ETF, again, several times over the last few years. If the IRS were looking at it, they would say it's a sham transaction. Imagine that a grocer got a tax deduction every time someone returned a box of cornflakes to his store. Heartbeats are when the grocer asks a friend to buy all of the boxes and return them just to pocket more deductions. Fund managers and bankers say that the trades are perfectly legal and that most of the taxes that they help regular ETF investors avoid will be paid in later years. The biggest ETF managers, including BlackRock, State Street, and Vanguard Group, all use heartbeats with help from banks such as Bank of America, Credit Suisse, and Goldman Sachs, according to market participants who spoke unspoken condition of anonymity. The fund managers reaping the biggest breaks, tax-free gains booked by the largest ETFs, State Street, BlackRock, Vanguard, all of them multi-billion dollars worth. To people in the industry, heartbeats are just smart tax strategies. It's removing a negative from the investment process. There really isn't a need to have to pay the tax every year. The goal is the best investor experience you can have. That's understandable, but you as an individual, you're not going to get these benefits. If you invest in the ETFs with the big institutions, that's all great. But there's a little caveat in there, so let's move on. To understand heartbeats, it helps to know that they are just a supersized version of something ETFs do every day. ETFs are funds whose shares trade all day on the stock exchanges. Unlike mutual funds, ETFs aren't sold directly to regular investors. Instead, they use banks and brokerage firms as middlemen. These large traders don't transact in cash. They make an ETF bigger or smaller by adding portfolio stocks to it or by taking them out. They call this activity, quote, creating and, quote, redeeming ETF shares. All of this is invisible to small investors who just buy ETFs from the brokers. So you're not able to know what's happening in the ETF. This is the problem with ETFs. Instead of building your own portfolio, you're basically a passive investor. You put a bunch of money in and you watch it grow. Unfortunately, on the way out, it's actually quite dangerous, but nobody wants to ever hear that. Enter the Nixon-era tax law in 1969. Congress decreed that mutual funds can hand over appreciated stocks to withdrawing investors without triggering a tax bill. Lawmakers never explained why they blessed the industry with this unique break, but back then it didn't seem like much of a giveaway. Mutual funds rarely took advantage of it because their investors preferred cash payouts. Fast forward to 1983, the American Stock Exchange executives devising the first U.S. exchange-traded fund realized that they could put out that old tax rule to a new use. Say an ETF needs to get rid of a stock that went up. Selling it would trigger a taxable gain and that would ultimately be paid by the fund investors. But handing the stock off to a broker who's making a withdrawal achieves the same goal, tax-free. Every time a broker redeems a stake in a fund, it's another chance to avoid taxes. That loophole gives ETFs a tax advantage over mutual funds. It went from a footnote in the tax code to a cornerstone of a new industry. For some of the earliest ETFs, which followed broad indexes such as the S&P 500 and rarely changed holdings, the daily process of brokers creating and redeeming was enough to wash away almost all capital gains. The first and largest ETF, State Street's SPDR S&P 500 ETF, hasn't reported a taxable gain in 22 years. In contrast, traditional mutual fund by Fidelity tracks the same index, had a taxable gain in 10 of those years. So in my opinion, we're going to see ETFs here to stay for a long period of time unless they change that tax law. I do believe that would be completely catastrophic to the ETF industry. It's going to be a huge swing. Not that they're necessarily going to do that. I'm just saying you got to watch it. If you're invested in ETFs, you need to watch what's happening with the tax laws. This is just basically a comparison looking at those. Here, if you're interested, ETFs proliferated and some new entrants shuffled their holdings more frequently, so routine redemptions weren't always enough to wipe out the taxes. The PowerShares funds, co-founded by Bond, started trading in 2003 and changed their portfolios every 3 months. He says that his funds wouldn't have kept capital gains taxes away without heartbeats. This tool was there. We were the ones to first really utilize it to its full potential. US stock ETFs avoided tax on more than $211 billion in gains last year. Funds pass taxable gains along to their investors, so by avoiding those gains, they're allowing investors to defer the tax until they sell the ETF itself. And I do think that's a good thing. You don't want to always be dealing with these taxes along the way. It would be good to have it just at the end, and that's the way that you have it. The $211 billion in avoided fund gains probably translate into about $23 billion in deferred taxes last year. It's the equivalent of a $23 billion no-interest loan from the U.S. Treasury to ETF investors, with most of the benefit going to the wealthiest Americans. That's generally the people that own these are those in the upper 10 and 20%. No, not the 7 shares of ETF, I assure you. Bloomberg Businessweek identified 2,200 such blips in equity ETFs since 2000. Last year, there were 548, worth a record $98 billion. Okay, this chart just shows you that. Look how much they have been really relying on these over the last couple years. You can see very clearly this is increasing year over year, and it's probably going to be that way for a long period of time. This shows you the heartbeat count. If I switch it over, it just gives you in terms of heartbeat value value sometimes going over $25 billion, all right? So that's a very, very large amount. It's not a small thing. This is not something that we shouldn't take notice of. Most heartbeats take place when an ETF has to get rid of a stock because of a change in the index it tracks. That was the case in September with State Street's $23 billion tech select sector SPDR. Some of the fund's largest holdings, including Facebook and Google, were dropped from the portfolio because they were leaving the index fund is designed to mimic. Both stocks had more than doubled since the fund when they initially acquired them, so it probably faced a hefty tax bill if it was going to sell them. It talks more about the specific trade there. I'm not going to bore you. I'm just going to move on. Basically, they're using this as a tax loophole that you and I cannot do on our own. This is the major institutions colluding together to be able to avoid those taxes. You as an individual aren't avoiding the taxes. When you sell, you got to pay taxes. But these corporations are able to do so because they have friends in high places. This is interesting here, just breaking it down. Look at the squares on the right-hand side, and you can see this. An ETF owns a portfolio of stocks and needs to drop one of them, stock H. And you can see if I scroll here, it'll show you a little more detail. Stock H has gone up in value, so selling it would trigger a capital gains tax. So the ETF asks a bank to become an investor. The bank contributes stock to the fund that mirrors the fund's portfolio. Okay, this is the little sleight of hand. A day later, the bank asks to withdraw its investments and the ETF satisfies the request with stock H. Since the ETF was given to a withdrawing shareholder, no tax is due. The ETF sells the leftover stock H since the stock was recently acquired and doesn't have any capital gains. This is what they're up to right now with ETFs. This is what's happening. If you want to know more about it, this article is going to break it all down. I know that this was long, it was detailed, there's a lot going on here, but essentially this breaks it all down here in this article. Fantastic written article out of Bloomberg. I think it's really important to track and trace what's happening within the financial industry. Look at the new tax laws that are coming out. If any of these change at any point, you're going to have a major disruption that is occurring within that. Of course, that has a ripple effect. Think about the companies that are involved, think about the investors, and think about what could happen as a result of all of the changes back with the Dodd-Frank, back with any of these other different changes that happened previously. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like on the video, you're supporting this channel, so I do appreciate that very much. If you want the financial education you weren't taught in school, these two books have everything that you need, from the foundation, the history, the asset classes, making money, so much more. Check it out at the link. If you want the audiobook, that's available at themoneygps.com. Steve Eisman from The Big Short just made a big bet on the next Big Short. If you haven't seen it, click on this video and I will see you there.